Welcome to Law You Should Know. The law affects every aspect of our lives, our home, our jobs, and our recreational activities. Now you can learn about the law and how to protect yourself against the loss of your liberty or property. Learn how to stand up for your rights and seek compensation when you have been wronged. Your host for Law You Should Know is attorney Kenneth J. Landau with the Mineola Law Firm of Shane, Dox, Denisi, and Corker. He's a member of the Committee on Professional Ethics of the Bar Association of Nassau County and counsel to the Nassau Academy of Law. And now, here is your host for Law You Should Know, attorney Kenneth J. Landau.
Hi, this is Ken Landau, and welcome to Law You Should Know. Today we'll be talking about understanding sales tax. And so both consumers and businesses know when they have to pay or collect or are exempt from sales tax. And we have two experts here tonight. They are Mark L. Stone. He's a CPA, and he used to work for the New York State Department of Taxation and Finance collecting sales tax and doing sales tax audits. And he'll tell us about what to do if you're involved with that. And Jennifer L. Koo. She's an attorney, and she used to work with the Attorney General Consumer Fraud Bureau, and she's very active with the Bar Association, Nassau County. Mark and Jennifer, welcome to Law You Should Know.
Thank you.
Thank you.
So just to start us off, just what's the basis and idea of sales tax?
So sales tax is really a transaction tax. It's really something that businesses collect and they charge consumers on the purchase of tangible personal property and certain services. But what a lot of people don't know is that there's a corresponding use tax. So if a business erroneously does not charge sales tax where they should, then the purchaser is supposed to self-assess that tax and voluntarily pay it into the state.
So ideally, a consumer wants to make sure that the business or seller is collecting and paying that sales tax to cover themselves.
Or they should self-assess it and pay it in themselves to cover themselves if that's what they're doing the correct thing.
And Mark, in any kind of transaction, the business or seller is supposed to separately identify the sales tax they are collecting?
New York law requires that a business, anytime they give a written receipt, separately state the sales tax that's being charged and collected on that transaction.
So whether you're buying a car or buying a cup of coffee, that's supposed to happen?
Correct.
And if the sales tax is not collected, then the New York State is going to come after you.
Well, what happens is the government randomly selects some businesses for audit, and they also have a program where they target specific businesses. And similar to the IRS, they have various what they call data mining techniques where they try to identify businesses and individuals that may owe them money. So when they target a business to see whether or not the business is correctly doing sales tax. So when I say correctly doing sales tax, that means both charging, collecting, and remitting sales tax on its revenue. They also examine that business's purchases to see if that business is paying sales tax on its purchases. And if it's not paying sales tax, they look to see whether or not that business self-assessed and reported use tax on its purchases.
Yes, go ahead, Jennifer.
And something that New York State Tax Department does very easily is that they compare a company's income tax return to their sales tax returns. A lot of times a company may have it in a separate account, prepare the income tax return, but they internally prepare their own sales tax returns. So the tax department will compare sales listed on the two different types of returns, and if they don't match, it's a trigger for an audit.
And when certain businesses are targeted or audited, they could be also targeted or audited for just not paying income tax on the income they take in.
Well, they could be audited for income tax. What we see a lot of is that the government does a lot of, again, data mining, do a lot of analysis. So they'll look at a restaurant, for example, and they'll see that the restaurant reports $750,000 a year in gross sales. But that same restaurant is also reporting $500,000 a year in food purchases. And the government has a whole bunch of statistics that they think are correct food purchases to go along with the restaurant. And they'll say, really, along with $750,000 of revenue, 1/3 of that number should be your food purchases. $250,000 is a ratio of 1 to 3. So if the business is showing $500,000 worth of food purchases, they really should have 3 times that number, $1.5 million in gross receipts, which means that may trigger an audit for $750,000 worth of underreported sales. And if the sales tax auditor finds that there's $750,000 of underreported sales, they report that to the New York State income tax people that then go after them for $750,000 of unreported sales and the related profit. And then sometimes the New York State income tax people then refer that to the Internal Revenue Service for an underreporting of profit.
And they might do a physical inspection to see how much food and other equipment they have, and estimate from there the amount of sales tax they probably should have paid.
So they do a physical inspection for really 2 different purposes. The first, they'll go in and they'll actually look around the restaurant. They'll count the number of registers, the number of point-of-sale systems, the number of terminals, to try to get a feel for when they do an audit, what they should be seeing. If there's 5 different terminals, then generally on a computerized system, the data in the system is going to identify that there's stuff from Terminal 1, Terminal 2, Terminal 3, and so on. When they look at the data, if there's nothing from Terminal 4 and 5, they're going to be very skeptical and say, well, where is the data from Terminal 4 and 5 going? What they'll also do is, if you don't keep any records, is they'll actually stand in the business for a day and say, all right, well, you know what, you were reporting $1,000 a day in sales, but we stood there for a day and we actually witnessed $3,000 a day in sales. So we're going to go ahead and triple your reporting for the entire audit period.
And then you have to challenge that by saying it's not true. You're almost guilty until you're proven innocent.
Correct. There's a presumption that if you're not keeping the right books and records, that whatever the government comes up is right unless you can show that it's clearly erroneous. So when the government comes in and they're watching a restaurant and seeing what their sales are, and they're doing it for Sunday brunch on Easter Sunday, we're going to argue that that's a very unrepresentative day, and you're not allowed to extrapolate that out over the course of a year.
And when they come in, are they coming in undercover?
Well, they don't generally come in undercover to do what's called an observation for the day. They do come in undercover, just dressed in regular clothes, which is how they dress anyway, maybe a few months before they start the audit, and they'll make a casual purchase for 2 purposes. Again, to see what you do. Are you ringing it into the register? Are you just taking cash and just putting it in your pocket? And if you're ringing it into the register, they're going to ask you for a copy of the receipt, and they're going to keep it with them. And then 3, 4, 5 months later, when they actually do the audit, they're going to request the point-of-sale system or the cash register tapes for that day to see if that sale shows up as a transaction or whether you deleted it to hide the cash that was received that day.
And do they watch for how many zeros are entered into the cash register?
They check for what they call no sales when you open and close the drawer. They look for voided sales. They look for manager comps. And they allow a little bit of that, but when half your sales for the day are voided out, they get skeptical of that.
And if someone is, let's say, buying a drink at a bar, is there sales tax on that drink?
Yes, there's definitely sales tax on all food or beverages sold for on-premises consumption. A question might be is whether or not they have to separately charge or separately state the sales tax on that beer. So if you go into a bar and get a beer and they don't give you a receipt, the bar is allowed to put up a sign that says sales tax included. But if, like most places now, they do give you a guest check, they give you a receipt, they give you a credit card transaction detail, then what they really have to do is say that beer was $4.60 plus 40 cents of sales tax equal the $5 that's due.
Okay, let's just for a moment move on to internet purchases, which is a big item today. So just explain who has to pay and who has to collect sales tax on internet purchase.
Well, internet sales are a very big thing today, but it's not really a very new law. If you're selling and you're selling into another state, you used to have a requirement to charge, collect, and remit sales tax in that other state if you had a physical presence in that state. So you're a New York business, you're selling into New Jersey, you don't have to collect New York sales tax on your sales into New Jersey. If you opened up a satellite office or satellite showroom, a satellite location in New Jersey, now you have a physical presence in New Jersey, you do also have to charge sales tax. So the internet just allows you to sell in many more states. What has happened over the past 5 to 7 years, states have expanded the way that they force businesses to collect sales tax when they're an out-of-state seller. So, for example, now, if you're selling through the internet, through, let's say, Amazon, and you're what's called an FBA seller, fulfilled by Amazon, what Amazon makes you do is deliver a certain number of pieces of merchandise that you want to sell through Amazon to an Amazon warehouse near you. Amazon then redistributes that inventory throughout the country. What ends up happening is you now have a physical presence in all the different states where Amazon has put your inventory, and you now have to collect sales tax in those states.
And let's say someone's starting up a business, whether it's a little practice or they're a home improvement contractor or they're setting up a store. Do they have to obtain a sales tax ID number?
So we strongly recommend that every single business obtain a sales tax ID number, whether you sell taxable services like a retail store or whether you provide non-taxable services like an attorney, an accountant, which services are non-taxable. But the reason for that is that attorneys' offices, accountants, engineers, architects, they all make taxable purchases. And if they make taxable purchases, sometimes I'm sure that they don't pay sales tax because the seller is not charging sales tax. If they file sales tax returns, even if it's a zero return showing no taxable sales due, it starts the statute of limitations running. So New York State Tax Department can only audit and assess any additional tax due from 3 years from the filing of a sales tax return. If sales tax returns are not filed, theoretically, the tax department can go back indefinitely, but their policy is to go back 6 years.
And if you work with a nonprofit and you're buying things for them, you're entitled to apply for a sales tax exemption, so the organization doesn't have to pay sales tax on your purchases?
So a nuance to what you said. When you say nonprofit, that's an IRS concept because that has to deal with profit, net income. Once you're a 501c3 approved by the IRS, you can then go to New York State and say, I want to become a tax-exempt organization. Then you do a separate application. That tax-exempt organization, once approved by New York State, does not have to pay sales tax on its purchases of everything.
For the organization.
For the organization.
Because if you use that number to buy something that's your own TV, you may get into trouble.
That's not allowed. And the actual purchases have to be made with tax-exempt organization funds. So it's not that you're allowed to go in and actually say, I'm buying this TV for the community room in the church. You have to actually use a church credit card or a church check. You're not allowed to really be reimbursed personally for purchases you make for the tax-exempt organization.
And the organization, the business should get a copy of that sales tax ID number form or whatever it is.
The seller is required to get a copy of the tax-exempt form and keep it for their records, so that way when the government comes in and looks at that seller's records and says, why did you not charge the church sales tax, they're going to say, well, they gave us a piece of paper proving that they were a church.
Let's talk for a moment about foreign purchases of art by either an individual or a company. What happens with sales tax upon your return to the United States or New York?
So what's interesting, actually, is that the New York Tax Department has recently been getting reports from the United States Customs. So when someone comes in and makes large purchases from overseas, they're required to report it to Customs, and New York State gets detailed information from Customs listing what was purchased, the value that you assigned to that purchase, where is it being sent to in New York State. So New York State will then go after the purchaser and say, you made a purchase of $500,000 of art from Paris that you had brought into New York State. You owe the use tax on that $500,000 of art. You need to pay that into New York State.
And what if you're dealing with an art gallery in Manhattan and you have it shipped to your summer home in Cape Cod? You still have, if you are actually putting it in your house in New York, you have to pay sales tax on that?
So what would happen is if the art gallery ships it into Massachusetts, if they don't have nexus, if they don't have a connection to Massachusetts, they won't have to collect Massachusetts tax. Since you have a house in Massachusetts, you might have to pay Massachusetts use tax on it. If you don't pay Massachusetts use tax, when you bring it back into New York, you're going to owe the New York use tax on the purchase of that art.
And you've really got you can't have an empty box shipped out to New Jersey or Cape Cod or something.
No, if you told the art gallery to ship an empty box to your Cape Cod house, and you actually walked out of the art gallery carrying the painting or the sculpture, you're committing tax fraud, and the art gallery is committing tax fraud, and there can be very unfortunate ramifications from that.
Okay, we're going to take a short break now. When we return, we'll talk about some other implications about understanding sales tax for New York. We're talking with Mark L. Stone. He's a certified accountant, and also he defends businesses and consumers with sales tax audits. And Jennifer L. Koo, she's an attorney, and she worked in their Consumer Fraud Bureau and also defends people and businesses on sales tax issues. And they're both, and Mark is the president of Sales Tax Defense, located in Dix Hills and serving customers all over New York.
Veterans, this is retired Army Colonel Greg Gadsden. In life after the military, it's our duty as veterans to have each other's back. If you recently filed a VA disability or pension claim and have been asked to go to a VA claim exam, I want to make sure you know what to expect. Go to va.gov and search compensation and pension exam to get the information you need for the benefits you've earned. Your VA claim exam. Know what's next.
Brought to you by the U.S. Department of Veterans Affairs.
Was it an Army?
Once again, we continue with Law You Should Know. From the Mineola Law Firm of Shane, Dox, Denise, Corker, and Sauer, here is attorney Kenneth J. Landau.
Hi, this is Ken Landau, and welcome back to Law You Should Know. We're talking about understanding sales tax both for consumers and businesses. We're talking with Mark L. Stone. He's the managing partner of Sales Tax Defense, and Jennifer L. Koo, who's an attorney and a partner of Sales Tax Defense. Mark, I understand you also have a lot of valuable information on your website. Can you just take a second and give us your website?
Certainly. It's www.salestaxdefense.com.
Okay, and we'll give it out later in the program. And attorneys may be able to earn CLE credit for listening to this program through the National Academy of Law. Just be sure to record the code number at the end of the program. And it's through the National Academy of Law. If you have any questions about it, contact them at 516-747-4070. There may be some administrative fee by the National Academy of Law. We've talked about art. We've talked about soda and some other food. Let's talk about capital improvements that may occur to a businesses or a house. When is sales tax due?
Okay. The general rule is sales tax is always due when a contractor does any kind of work. And then the next step is that the homeowner, the business that's having the work done, says to the contractor, no, this work is permanent in nature, it's adding value, it's prolonging the useful life, and we're not going to remove it. So therefore it qualifies as a capital improvement. The homeowner or the business where the work is being done gives the contractor what's called a capital improvement certificate, and then the contractor does not have to charge that person any sales tax at all. However, since the contractor is not charging sales tax on either the labor or the materials that they used, the contractor is deemed to be the consumer of those materials, and the contractor has to pay sales tax or self-assessed use tax on the purchase of those materials.
So there can be distinctions between the nature of the work or services, such as the type of flooring or whether it's permanent fixture like a fireplace versus a sound system?
Correct. So if it's not a capital improvement, it's generally considered either an installation of tangible personal property or repair and maintenance work. In either of those two cases, the installation of property or repair and maintenance work, the contractor is required to charge sales tax on both the labor and the materials. But then, since the government's actually not looking to double tax the contractor, in those cases, the contractor does not have to charge or does not have to pay sales tax on his or her purchase of the materials.
And how does this apply to interior decorating and design?
So, in addition to the sale of tangible personal property, New York State says that various services are subject to sales tax. One of those services is interior decorating and design services. So if someone's providing interior decorating and design services, they need to charge you sales tax at the full sales tax rate, roughly 8.5%, anywhere in the state. However, New York City says that interior decorating and design services are not subject to sales tax. And since, if you didn't know, sales tax is really half New York State money and half county money, if you have interior decorating and design services delivered to any of the 5 boroughs of New York City, you only pay about 4.5% sales tax in those locations.
And what if it's provided in the city, but the house is in Nassau County or the business is in Nassau County?
It's actually where the interior decorator delivers their services. So it would depend where you meet with them. Generally, it would make sense that you would meet with them where the property is located, but there might be a case where you're meeting with them someplace other than where the property is located.
Okay. You mentioned some interesting examples earlier of food items, and on some food items, sales tax has to be paid, and on others, it does not.
Yes, they break food into a number of different categories. So the first food category they break it into is prepared food. Prepared food is basically anything that's ready to eat. And also usually if it's being sold either hot or you're trying to keep the food hot, that's always taxable. A second category is what they call on-premises consumption. On-premises consumption is clearly like when you go to a restaurant. The restaurant is going to charge you sales tax because it's for on-premises consumption in most cases. It gets a little bit more tricky when you get into supermarket-style food. New York State goes a step further with supermarket-style food. They break it into things that are a necessity and things that are more of a luxury item. So one of the examples we were talking about was bakery items. Bakery items are not subject to sales tax, but candy and confectionery are subject to sales tax. So the question is, what do you do with a Twix bar, which is a chocolate-covered cookie? Do you charge sales tax on it or not?
And things like pizza, there must be sales tax on those.
It in some cases depends on what the supermarket is actually holding it out to be. So for a while they were saying that if you put the Twix in the candy aisle, it's a candy and you have to charge tax. If you put it in the cookie aisle, then you don't have to charge tax. About a decade ago, one of the New York State tax commissioners actually said, I really like Twix, so therefore we're going to classify it as a cookie and not charge tax on it.
Now let's talk a moment about what the work and sales that you do with sales tax defense. You can help an individual or a business to help avoid sales tax problems by following some of the suggestions you've outlined here. Or if they find out they're subject to an audit, how can you help them if they're the subject of an audit?
So the way that would work is when the government comes in, of course, they're looking to charge you as much money as possible. Sometimes fairly, sometimes very unfairly. And sometimes it all depends on exactly how you explain what's being done. We talked briefly about capital improvements. You want to make sure that if you're the contractor and you're being audited, that you have all your paperwork, you have all your capital improvement certificates. You want to be able to explain to the government why the work that you're doing actually qualifies, why it's permanent, why it's adding value. And a lot of contractors are not versed in the terminology that you use or need to use to prove that something's not taxable. An interior decorator might not know to explain to the government that most of the work is delivered in New York City, so therefore it's only subject to half the rate. So a lot of what we do is either making sure that clients have the right documentation, understand the law, or that we explain to the government the right way so it's not subject to sales tax.
I just would like one of you to comment on if you don't pay sales tax, what are the consequences?
So if you don't pay sales tax, if you've been assessed by the New York State Tax Department, and they'll give you an opportunity to enter into a payment plan, of course, pay in full, If you don't pay it, it is not dischargeable in bankruptcy. Sales tax is not dischargeable. And New York State will spend 20 years collecting against you for that sales tax due, which includes issuing liens, levying bank accounts, suspending your driver's license. So it's something that's really big that New York State would definitely go after you for.
And it's collectible from the individuals who are leading the firm, not just the corporation?
So sales tax is really collectible on a transaction, I'll say 4 different people. The business that makes the sale, the business that buys something from the seller, the owners or officers of the business making the sale, and the owners or officers of the business that made the purchase. And the government has the right to go after whomever they want. They don't have to be fair about it. They go after either who they find first or whoever has the deepest pockets. And as Jennifer said, once they assess you, they don't stop chasing you for 20 years.
And as you mentioned before, you can also help businesses at that stage of the transaction.
Yes. So if a customer, if an individual has been assessed sales tax and they want to resolve it, if they want to try to settle with New York State, we can help them do that. We can, what's called an offer and compromise program, we can work with the taxpayer and submit and prepare the necessary paperwork to request a settlement with New York State, or something as simple as setting up a payment plan. We can do that as well.
Go ahead, Mark.
And something that we also do is if you get a bill from the state and you think it's not fair, not only can we contact the state and dispute the bill, but we handle hearings through the whole appeals process, which starts with an arbitration hearing before the Bureau of Conciliation Mediation Services. And then Jennifer can take cases to court where you fight it first with an administrative law judge, and then you go before the Tax Appeals Tribunal. And if you're still not happy with the result, Jennifer's taken cases all the way up to Albany and had a 5-judge panel listen to her argue cases disputing that sales tax is not due on transactions the government said was due.
Okay. We just have a few seconds. Any other tips you'd like to provide in how to avoid sales tax problems?
The biggest thing that a company should do is know whether or not they should be charging sales tax. If they should be charging sales tax, make sure that you charge it, collect it, and remit it. If you're not sure whether or not that you should be charging sales tax, please, contact somebody. And if your customer says to you that I don't have to pay sales tax, make sure you get the right paperwork from your customer to document why you did not collect sales tax from them.
Okay, and just give us your website again.
www.salestaxdefense.com.
Okay, I'd like to thank Mark L. Stone and Jennifer L. Koo for being with us and talking about understanding sales tax. If you're a lawyer listening to the program, the CLE code is 1980-ART, 1980-ART. And if you missed any part of this program, you can listen to the podcast at nccradio.org. This is Ken Landau, and you're listening to Law You Should Know on 90.3 WHPC, the voice of Nassau Community College. And also, please join us next week at the same time for another program on Law You Should Know.